The world of digital money is a wild ride. One day, green charts and optimism, the next, a sudden plunge. On Monday, January 19th, 2026, nearly every major cryptocurrency took a sharp, synchronized dive. The biggest names in crypto all fell together, signaling a powerful external force at work. The drop hit during busy Asian trading hours, amplifying the effect as panic selling rippled across global markets. Crypto's 24/7 nature turned a tremor into a market earthquake in hours, leaving investors shaken and questioning what triggered the chaos. Events like this highlight how quickly sentiment can shift, and how global forces, not just tech or hype, drive these digital assets. The story of this drop is about fear, risk, and the powerful influence of world events on even the most decentralized markets. Bitcoin, the market's bellwether, led the plunge, falling from above $95,000 in a matter of hours, sending shockwaves through the entire financial ecosystem. The suddenness of the drop caught even seasoned traders off guard, as the world's most recognized cryptocurrency tumbled with little warning. The price slipped to below $92,000, erasing billions in market value almost instantly. For many, it was a moment of disbelief, as screens everywhere flashed red and alerts buzzed with urgent updates. This 3.6% drop shattered a key psychological barrier, triggering automated sell-offs and deepening investor anxiety. The breach of this level set off a chain reaction, as trading bots and algorithms kicked in, accelerating the downward spiral. In crypto, round numbers matter. Breaking them can spark a cascade of selling and erode confidence fast. These thresholds aren't just technical, they're emotional, shaping how investors react in real time. The speed of the decline was alarming, even for a notoriously volatile market. Within minutes, panic spread from trading floors to everyday investors, amplifying the sense of uncertainty. Investors, big and small, watched weeks of gains evaporate, a stark reminder of the risks that come with digital assets. For some, it was a painful lesson in the unpredictability of this new financial frontier. Bitcoin's tumble wasn't just a number, it was a gut check for everyone in the space. Conversations shifted from excitement to caution as the reality of volatility set in. The event underscored how quickly fortunes can change and how closely crypto's fate is tied to global sentiment. News traveled fast, impacting markets from New York to Tokyo, and reminding everyone that crypto is truly a global phenomenon. The story of Bitcoin's fall is a lesson in the volatility and interconnectedness of today's financial world. A world where numbers on a screen can shape the hopes and fears of millions in an instant. The pain didn't stop with Bitcoin. This time, the entire crypto market felt the shockwaves. As Bitcoin's price tumbled, it dragged the rest of the digital asset world down with it, sending a clear signal that no coin was safe from the sudden wave of fear. Ether, the second largest cryptocurrency, dropped nearly 5%, erasing billions in value in just a matter of hours. The sell-off was swift and relentless, catching many investors off guard. Meanwhile, Solana plunged over 8%, suffering even deeper losses as panic spread. The rapid decline highlighted just how quickly sentiment can turn in the crypto space. When altcoins fall harder than Bitcoin, it's a classic sign of a risk-off market. Investors flee the riskiest assets first, seeking shelter in whatever feels safest, or sometimes just heading for the exits altogether. Bitcoin is often seen as the safe crypto, the digital gold of the market. But on days like this, even it isn't immune to the broader panic, and its price can't escape the gravitational pull of fear. The deeper losses in Ether and Solana showed a rapid flight from risk, with investors dumping anything volatile. The rush to sell was visible everywhere, from city streets to trading floors. This wasn't about a single project failing. It was a broad reaction to outside threats shaking the entire asset class. Uncertainty about regulations, global events, or even rumors can trigger these sweeping moves. The hierarchy of risk in crypto was on full display. When fear hits, the riskiest coins get hit hardest, while the so-called blue chips like Bitcoin still take a hit, just not as severe. Understanding this dynamic is crucial for anyone investing in digital assets. It's a reminder that volatility is part of the game, and risk management is essential. The market's message was clear. Uncertainty was high, risk appetite had vanished, and only the most resilient investors would weather the storm. What triggered the sell-off? A political bombshell from Washington, D.C. President Donald Trump proposed new tariffs on 8 European nations, raising fears of a trade war. Tariffs are taxes on imports, meant to protect domestic industries, but they often spark retaliation and disrupt global trade. The announcement sent a wave of uncertainty through the world economy, threatening higher costs and slower growth. Financial markets hate uncertainty, and this news hit when the global economy was already on edge. Investors feared a trade conflict could stall growth worldwide, dragging down profits and investment. The tariff news wasn't just politics. It was a major economic event with global ripple effects. Investors responded by fleeing risky assets, including crypto, in search of safety. Why do tariffs spook markets so much? The answer goes beyond just higher prices on imported goods. Tariffs are a signal that the rules of global trade are changing, and that makes investors uneasy, because they inject massive uncertainty into the future. Suddenly, companies and investors can't predict costs, profits, or even which markets will remain open. Businesses can't plan when they don't know how trade rules will change, so they delay investments and hiring. Projects get put on hold, and expansion plans are shelved until the outlook becomes clearer. This hesitation slows economic growth, which hurts corporate profits and, in turn, stock and crypto prices. Uncertainty ripples through every sector, from manufacturing to tech. When uncertainty rises, investors shift from risk-taking to risk avoidance, selling volatile assets and seeking safety. They might move money into cash, government bonds, or other safe havens. Tariffs can also fuel inflation, making goods more expensive and forcing central banks to raise interest rates. Everyday items from groceries to electronics can suddenly cost more. Higher rates slow borrowing and spending, compounding the economic drag. Consumers and businesses alike pull back, deepening the slowdown. The result? A chain reaction of fear, selling, and falling prices across all risk assets. Market sentiment can shift in a matter of hours. The tariff announcement set off this domino effect, prompting investors to cut risk immediately. Headlines and breaking news only amplify the panic. In moments like this, crypto's volatility makes it one of the first assets to get hit. Investors rush to the exits, and prices can tumble fast, reminding everyone just how interconnected the global economy really is. The sell-off wasn't limited to crypto. Stocks and other risk assets fell worldwide. This broad decline showed the problem was macroeconomic, not just a crypto issue. Crypto's integration into mainstream finance means it now moves with global risk sentiment. Large funds treat Bitcoin like any other risk asset, selling it alongside stocks when fear strikes. This new reality brings legitimacy and capital to crypto, but also exposes it to the same shocks as traditional markets. The tariff news proved that crypto is now part of the global financial system, not a niche outlier. When Wall Street panics, the crypto world feels it too. This week's events show how global politics can hit your digital wallet in real time. Crypto may seem separate from the headlines, but its value is tied to investor confidence, and that's shaped by world events. A tariff decision in Washington can ripple through companies in Europe and Asia, ultimately shaking crypto prices. As more institutional investors enter crypto, their risk models treat Bitcoin like any other asset. If global risk rises, they sell. For crypto investors, it's no longer enough to follow just blockchain news. You need to watch the world stage. Political moves, central bank decisions, and international tensions all move the market. Understanding this web of connections helps you make smarter decisions and avoid being blindsided. In today's world, your digital wallet is part of a global financial network. Everything is connected. Crypto often reacts more violently to global shocks than stocks do. Solana's 8% drop dwarfed the declines in major stock indices. Why? Crypto markets are younger, less liquid, and more sentiment-driven. Fewer buyers and sellers mean big trades move prices fast, especially in altcoins. Unlike stocks, crypto lacks clear valuation anchors. Prices are driven by future potential and emotion. The market never closes, so news triggers instant global reactions. No timeouts, just volatility. Automated trading and human panic can create feedback loops, amplifying swings. This structure makes crypto a roller coaster, uniquely sensitive to every global tremor. January 19th's plunge is a lesson for every crypto investor. Global events matter. Crypto's value is shaped by politics, economics, and central bank moves, not just technology. Staying informed about world events is now essential for managing risk in digital assets. Understanding why markets move helps you avoid panic selling and stick to your plan. Volatility is part of the game. Sharp drops and rapid rebounds are the norm. Diversification, discipline, and perspective are your best tools in this unpredictable market. Each cycle teaches us more about how crypto fits into the global system. The adventure continues. Be ready for the next twist.